Oh, what's up, buddies? Welcome to Huobi live chat. Today is the 9th of August, and today we are going to talk about some interesting topics like Ethereum fork, and then we'll analyze major economic data, and then finally we'll move on to some tokenomic analysis. We will talk about the perpetual and the token, which is going to have a upgrade, and also the Chainlink 2.0. We are going to talk about these topics. And let's start off by having a market overview of Bitcoin and also Ethereum. And let me switch the screen. So me and Dave today will be talking about the topics that I just mentioned. And let's look at Bitcoin. And it's now standing at 23K. Previously, it tested the resistance here, 24K, but however, we are seeing some supply stepping in, and a downward pressure is now observed, and it's not that bullish at all. And as for Ethereum, we can look at the chart that is still in the parallel channel, the uprising channel that we are now seeing, and is now standing at 1700, 1.7K, and the reason big red candle is not very bullish, and it signals a large amount of selling pressure stepping in. Probably we are going to retest the lower boundary of the channel, and as we can see from the chart. And yeah, let's see how it develops. And for Bitcoin, I think it's going to test the 22K, the major support line here, and that will be a very important area for us to observe. And we are now, having a pullback, and it's very important to, stay updated to prices in the coming days. So without further ado, let's get back to the main topics of our weekly market chat. We have a very funny We have a funny meme on the right hand side. The Saudi short squeeze is simply starting. The Saudi memes are, really trending right now, and it's really funny to scroll Twitter and see all these memes. And yeah, so let's talk about Ethereum fork. As we have covered in the last episode, we talked about the issues that are associated with the Ethereum fork, whether people will support, whether developers and also projects will support the Ethereum proof of work, the chain, the fork chain, or will they move on to support the Ethereum, the Ethereum 2.0, the proof of stake. And some projects already announced their stance towards the Ethereum 2.0 upgrade. For example, Chainlink is going to support Ethereum 2.0 proof of stake, and other projects are now yet to announce their position. And it's really interesting to stay tuned to how these projects will add to the upgrade. And yeah, Dave, would you talk about the Ethereum fork? And we have a timeline here. Probably we can elaborate on the chart so that you guys can understand, you guys can get to know more about the Ethereum Classic.
Cool. So I think like Ether is going to provide a platform of strategies for our crypto buddies to become the crypto whales in 2022. So for Ether, we first have to understand that what's the edge, what are the opportunities, and what are we going to do. So what's ETH? So ETH is like, when ETH is migrating to like a proof of stake, just like last time we've spoken. So ETH is going to have a fork. So now we name it as ETHW. And that's basically the original, proof of work ETH, so that is like a version of a fork compared to, the upcoming ETH merge that is, proof of stake ETH. So basically, when we compare last time, sorry, last time, like, in, July 2015, we have like, first like, ETH fork, so that we have, ETH Classic. So at that time, ETH Classic, prices just slumped, they just, went from all-time high to the floor price, and back in those days, people would like to talk about, like are things going to migrate, or it's like if classic is going to work. So basically it doesn't, pretty work as much as, if now. But basically, if you know about the if ETHW catalyst, if classic, just rise from the floor price to like 30%, 80%, for a month. So why is that? It's because like people are betting on if classic that's similar to if W. So basically, if you know the catalyst, you basically do the trade on if classic, and you have like probably like 50% to 80% gain per month. Not investment advice though, but when we see that ETHW is coming, we tend to see and if there is another opportunity that we should notice. So like like so go back to like news. We have like Justin Sun, Poloniex. That exchange is going to support ETH hard fork, and there is another exchange. BitMEX that was founded by Arthur Hayes. So this exchange also announced that they are going to support the ETH fork. So people are going to have speculations on these assets. The ETH proof of stake, merging into the pool. So we also have the ETH fork, ETHW perpetual futures on BitMEX. So if we have listed, or if we are going to list that ETHW on our exchange, we'll get to notify you as soon as possible. So right now we know what is the ETH. So like let's jump to like what are the potential opportunities. So for the potential opportunities, it's like there are like 5 points I would like to talk about them that is going to make you money. No investment advice, no financial advice though. So like we have now STETH. So STETH is going to have a discount, compared to the normal ETH price. So if the if proof of stake, catalyst is going to have a big driving effect to the market, we tend to see a STETH discount rate right now. Like it's like 5%, or stuff. So we are going to, if people are going to bet on that, people are going to buy STETH and sell to like ETH after ETH migration. So this is sort of like after the free AC and stuff, we tend to see like more people are like liquidated with their STETH as collateral. That's basically saying that some whales or some institutions deposit STETH into like lending and borrowing protocol like Aave, like MakerDAO or stuff. They basically deposit ETH or STETH, the ETH. So when the market goes down, the STETH had a sort of like the peaking event that it was like sort of like discount with 10% or more. So like right now, if we buy STETH, and if we have a big driving event from the Ethereum proof of stake catalyst, we tend to see STETH stake ETH is going to rise back as previous price with the 1-to-1 peg ratio to ETH price. So probably this is sort of like a arbitrage, long-term arbitrage opportunity. What do you think about this sort of like opportunity or this sort of like strategies to you, Johnny?
Yeah, we have seen the depacking of SDETH to ETH in the previous months, especially when market had a lot of turbulence back then in March to May. And for some people who don't know what SDETH is, SDETH is actually you can think of like a security offered by Lido, which is a Ethereum 2.0 staking project. You stake Ethereum in Lido and you take SDETH out. And by holding SDETH, you actually has a stake in a collective stake of Ethereum 2.0. So that later on, by holding SDETH, you can redeem Ethereum 2.0 later upon the success of the upgrade. And so why people have to purchase SDF is because the Ethereum 2.0 staking is quite expensive for retail traders and retail investors because they usually require a large sum of Ethereum to be staked, for example, like 32 Ethereum at a minimum, and then it's actually a entry barrier to a lot of retail traders and investors who don't have a large amount of capital, and that's why people with a limited investment quota would go to invest in SDETH, and it becomes a entry for more people to participate in the Ethereum 2.0 staking, and and it's actually a vehicle for for more people to stake into Ethereum 2.0. And yeah, and as as we approach to the announced date of the expected merging of the Ethereum 2.0, which is supposed to be happening in September, and we can see that the pack of STF to ETH is closing. The gap is actually closing because of the risk of the waiting time. Maybe we expect some as people expect there will be some risks associated with the merging, and when the time comes close to the merging date, and then the risk is actually reduced, and therefore we are seeing the gap closing up. The STF is now regaining the pack to ETH, and it actually signals a confidence for the Ethereum 2.0 merging. And yeah, there are definitely some opportunities out there. People can purchase SD at a discount if it's still deemed as reasonable. And now some people would purchase more SDE as the Ethereum 2.0 is coming closer, the upgrade is coming closer, and yeah, but there will also be some risks that we should also pay attention to. For example, the Ethereum 2.0 merge may delay again, and that's we've been witnessing for the past few years. It's been saying that the Ethereum 2.0 will be upgrading, merging back then 2 years ago, and then right now we are still saying the upgrade is close, and there are systematic risks. There are other risks associated with the upgrade, and that's what we need to we to take the risk and also to consider before purchasing the SDETH and stuff like that. Yeah. So that's my opinion, Dave.
Cool, cool. So yeah, there is certainly like probability that if it's going to delay, but let's
Yeah.
just not make it worse, So assuming we are going to have the proof of stake, migration possible, and like in September, like what the developers or the developer community said, is going to happen. Let's say just a great, great assumption. So on the other side, like in the other side, for people to benefit from this, ETH fork is probably to buy ETH fork, token from the DEX, and sell it to exchange when there's a CEX listing. So I'm going to break it down step by step to to our crypto buddies that how are we going to do that? No investment advice though. So first we're going to buy worthless, if proof of work in the fork. So let's say it's just like if W is it has a ticker symbol, if W ETHW. So for example, why do we do that? It's because at the in the beginning of time, so people are going to talk about a fork is like worthless, it's not gonna worth a penny or stuff. That's just say is an assumption. So with that assumption, we're going to see a lot of discounted prices on the ETHW, the fork token. So basically, if people are saying it's going to crash down, it has no value. If that happens, it's going to crash price to the floor price or to a very undervalued, mispriced scenario. So in this scenario, we are going to buy a lot of like ETHW for a very discounted price. No investment advice though, again. But if we see that this mispricing is going to happen and we buy a lot of them, we accumulate them. Just don't dump it. token dummy on the market. So when CX is going to announce another sort of like wave of listing, we're going to see like for example, let's just say Binance is going to listen, Huobi is going to listen. Let's say FTX is going to listen. So every time when tokens are listed on the exchange, their prices are pumped, a lot. You look at API free, you look at the Graph logo, all these tokens they are pumped a lot the day when the news announced that they are going to be listed on this major CX centralized exchange. So when we accumulate, the ETHW fork token at a very mispriced and discount price, we're going to sell it, on the exchange or on the DEX when there's the day that these if fork tokens are going to be exchanged to the market. So this is like listing strategies or a pump and dump strategies. So there's also risk associated with that. For example, like it may go reverse. Like for example, if people are going to say E4 is going to have a lot of value, so these strategies may not work, may not probably work. So if people say that E4 or they are maxi on the POW ETH, that means the original version or proof of work version of the Ethereum. So basically, we do not use that strategy to buy, in this scenario, higher prices of proof of work ETH, THW, ETHW fork token, and we can't sell it for a lower price when there is this sort of like probably CEX exchange listing. But for the fact that like many people are talking about that the POW ETH fork, the ETHW token is going to have a no value scenario. We're going to definitely, use that scenario, use the strategy to profit from the mispricing and profit from the arbitrage opportunity. So on the on the third side or this third analysis on this ETH fork, we also have to review on the collateral risk on the DEX and borrowing and lending protocols. For example, Aave and sort of like for example maybe make it out. Why is that? It's because when there's a ETH fork, most of the tokens when they are not successfully or completed in this merge or the migration to the proof of stake protocol, we probably have to see that if these protocols have enough or sufficient or a great level of sort of like governance. So if the governance is not happening, probably we're going to see a cancellation of the collateral of ETH4 ETHW. This is because like if it's proof of stake, officially proof of stake, right? So if we see that some protocol that does not provide successful migration for the if proof of stake version for their collateral, probably the collateral are going to become the ETHW ETH fork token. So this is going to probably in the scenario probably pose a threat to the collateral risk on this lending and borrowing protocol. So investors or traders, if you have collateral on these sort of lending and borrowing protocols, you get to have to watch the six. So that's just my opinion. But like, what do you think about that, Johnny? What do you think about
And
the
we should
eighth
also we should also
fork?
be aware of the market sentiment towards ETH and also ETH because market sentiment is a lot of times affected by people trend what's trending on social media and it's worth paying attention to the narrative. For example, right now we can see that it's very controversial for this issue. Some projects support Ethereum W and some projects will support Ethereum stake. Some people say that Ethereum W is going to zero because it's not very practical and useful because we already have Ethereum Classic. And some people say that It's not like that because the miners are working on the Ethereum proof of work will not will support the hard fork will support the Ethereum proof of work, and we are seeing a lot of controversies over there. And in my opinion, I think it's best to just stay at a comfortable position to observe the market sentiment and also the narrative, because we still have a lot of time, right? We still have a month ahead, and I expect that the Ethereum merge will probably postpone, and that's why we should always stay calm and also to think and also to judge objectively, not based on other people's opinion, but to do our own research and our due diligence, taking into facts and to researching into whether Ethereum proof of work still worth the price, or it's actually not very worthy. But that's another thing, because in terms of valuation, we have to consider supply and demand, and supply is actually affected by market sentiment and also narrative, because ultimately supply will come from holders, right? And then demand as well. Demand will also have to pay attention to the market sentiment and also narrative. If more people think that on social media, if it's trending that people will, oh, see, we are supporting Ethereum work because we still find it very useful for some projects we're actually working on. Some projects are already developed on the Ethereum proof of work, and some different narratives will come up, and it's better to stay objective and to think critically about these opinions and facts to come up to our own conclusion. So next week we'll bring on more news about the Ethereum fork, because it's still evolving. The issue is still developing, and we are seeing more and more opinions, and also we are seeing more developments over the controversy whether the Ethereum proof of work is going to zero, or it will be fine. We will definitely bring you more news about the Ethereum fork next week. So I think we should maybe let's move on to other also important topics, because in the later part we are going to cover some very important indicators that will make you make you become crypto wells. As you can see, they've already changed his icon to inverse stream camera, and then we already know Dave has got a lot of important stuff to tell you guys. And so let's move on to the major economic data release. In order to become crypto whales, you also need to pay attention to the news coming ahead. For example, the non-farm productivity news coming today, and also the unit labor cost. As for the last week, we already had the data of the non-farm payroll, which indicated that the situation is not that bad, right? Because comparing to we're actually seeing the employment recovering from the previous low. But however, when we compare the data to the 2019 COVID and 2020, comparing to that period, we have not fully recovered from the employment health. We are still down 500,000, and it's still worth noticing that we are seeing as the last 2 weeks, we already knew that the Q2 GDP is coming at a negative percentage, so at 0.6, and that's a not very good indicator. And we also have not fully recovered from the employment point of view, and then that indicated a negative market sentiment, because people will think that the economy, as reflected from this data, we cannot conclude that we are in a healthy trend, and the possibility of a bullish trend developing is actually diminishing, right? Yeah. What do you think about Dave?
Yeah, so I completely agree. So like what I want to have takeaways for my audience is probably like I don't know. So for our crypto buddies, we need to know our tokenomics. We need to know about strategies, trading. Buy slow, buy low, sell high, and a lot of stuff. Trading.
Yeah.
Network effects. Investment strategies, venture capitals, and stuff. But we also have to know. We also have to step ahead on behalf of other people to step ahead to know the market before everybody. So probably one of the edge is probably like the macroeconomics data. So probably that when we see the one farm payroll, last week or so, we probably see that it's like two times from the expectation. So probably we can see that we have a very healthy, comparatively very healthy economy, that we are not going to enter a very, pessimistic, recession. So we may enter the technical recession, but probably that we are not going to enter a very, pessimistic or very long time of recession. So like probably, when we see that this major economic data release, we have to, expect or bet on it. For example, if we have, the CPI, we're knowing that it's going to come down, like, the four, episodes before or four podcasts before, we already, told our audience that we should expect or we should technically analyze whether these commodity prices are driving up or down the CPI in the coming months. So for example, bet on CPI, we know that CPI is going to go down, so we bet upper. So market is going to front run, or so to speak, to price in the economic data that is coming or so. So like for example, if we take a look at the Wednesday level or the Thursday, economic data release, that is basically, we have another, like CPI year over year change, CPI month over month change. We have like crude oil imports, we have like crude oil inventories, and we have also like, initial jobless claims, and then PPI, month over month and year over year change. Probably these, types of economic data, we're going to see a lot of, market turmoil, oil, and also the volatility of the whole market. So, as an investor or a trader, no investment advice though, we should take a look at this data, like 1 week or 2 weeks before they are released. Although I know that, for example, for retail investors, probably we don't have, sort of like as many resources or as many types of resources as the giants or as the institutions. But we can, take a look at trading wheel, the commodity prices. We can take a look at trading wheel, the economy data, Fed fund rates, sort of like the CPI, the inflation, whether they are going to peak or not. So probably if we also see that unemployment rate is on a downtrend, that means more people are being employed. And that basically means that, people are going to have, a good great scenario or great condition of, being employed. More people employed, more jobs, best for the economic growth. So on this, expectation of data, we should, expect a market movement to front run or to price in or to price out this sort of scenario. So as a traders, we have to take a risk, portfolio or risk analysis on this, scenario and make a probability bet on that. So that's basically my opinion. Do you think that you have like sort of like anything to add on based on this there or this, trading ideas or stuff, John?
Yeah, I think one tip that we think I think is very useful for you guys is that actually you can maybe we can you can find out the expected data release. For example, if we expect the CPI next month, for example, July, to be standing at, for example, maybe let's say maybe 7% or 8% because it's down a little bit. And then, however, when data come out to be more optimistic than what we expected, and then we have a contrast in our expectation and the reality. And that contrast, if that turns out to be positive, and then we are going to see a pump. So I think that's a thing that we can research on and work on, prepare, and also to think about the market expectation and the coming out, the real data. Are there any discrepancy? If there is discrepancy, and then we can actually take advantage of that discrepancy and make some profit based on it, right? That's what I think about. Let's move on to Um, this very, looks like complicated, but I think Dave will, help us go through the data in this chart, and let's tell our audience what this is about, Dave.
Cool, cool. So like to help our audience or to have more takeaways, give more takeaways for our audience, we also want to, sort of like do some sort of like automatic or the predictive model on our economy so that we can, have a price level or expectation or a probability bet on the risky assets like SPX or crypto or NASDAQ or stuff. So like for these, this model is basically from a data stream from institutions. So probably we will have to see the institution or how they are willing or revealing the data from the economy to buy or to bet on the SPX or risky assets. So just like what we told you about, told our crypto guys that the net liquidity level or the indicator or also other sort of like like reverse repo or some sort of like very technical stuff that we explained in our last weekly market chat. So basically this time we'll focus on year over year change and stuff. So sort of like when we see this chart, we probably see like there is like a purple line, a darker purple line that's basically the 1 year percentage change of GDP, over the United States, on the outright scale. And also the pink line that's representing, the U.S. Treasury constant. That is the 10 years, a constant for the Treasury stuff. So and we also have the orange line. That's the orange line that's symbolizing the 1 year late of sort of like a percentage change of the S&P 500 composite. So for this orange line, that's very important that we have to know that if there's any sort of like leading indicators or lagging, so that we have to see or we can price in or front run with the whales of the institutions before the market reacts. So like for this graph, the orange line is lagging by the sort of like the purple line and also the sort of like the blue line. So for the purple line, we tend to see as we explain it, so it's like a 1 year percentage change of GDP. So this is sort of like also can be calculated. I'm going to tell you guys how can we calculate this well. Basically, we just have to go to for my calculation, investment as milestone. But let's just start. We just go to investing.com, so we can see that how many people are betting on, you know, um, sort of like what's the expected value of GDP, US GDP, year over year change, month over month change, and also the exact value of the GDP. So we can calculate it, and predict, how GDP is going to run in the other, quarters or other years or even other months. So if we, know that, we tend to have a probability that we can draw the line on the sort of like the purple color, or the sort of like the purple color. So with that expectation of that calculation or the drawing the indicator, we already have the leading indicator or one of the most important leading indicator for the market or for the risky assets like SPH, the S&P 500 on NASDAQ, basically on also the BTC, Bitcoin. Basically, what we see is that we also have a very high correlation between Bitcoin, S&P 500, and also NASDAQ for the month over month for these like 2 months or so. So basically, if we have this indicator, as I said, like go to investing.com or go to trading economics, .com or stuff, we tend to have these data from these free available resources and calculate the leading indicator. So John, what do you think about the sort of like the other indicators like the the correlation between the S&P 500 and Nasdaq and other correlations?
Yeah, this model, actually we have to give credits to Robert P. Ballen because We actually took the model from from him to share the economic data to you guys, and full credits to him. He's a very great analyst. You guys can just search Huobi, but not we are not in some beneficial relationship with Huobi, but we just found out that this model actually help us into researching the economic environments, as we can see from the charts here, the net lending, also net exports with 10-year U and also SPX. And we actually have more findings because last episode we told you guys we are actually working on some indicators, macro indicators, actually checking the liquidity flow of the Federal Reserve balance, and we link them to the SPX. They explain some important programs offered by the Fed Reserve, for example, the RRP, refers to purchasing agreement used by the Federal Reserve to absorb and also withdraw liquidity in the market to the federal balance. And it's a very important indicator that we are going to introduce to you guys. We'll certainly talk about this later. So yeah. Uh, yeah, let's look at this chart. This chart is actually the relationship between Bitcoin, SPX, and also Nasdaq. And on the upper side, we have the charts, price charts of Bitcoin, SPX, and Nasdaq. At the bottom, we have the correlation chart of SPX to Bitcoin, and also Nasdaq to Bitcoin. We can see that the correlation is pretty strong all the way from 2020 to 2022. These 2 years, Bitcoin has a very strong correlation to some risky asset like SPX and also Nasdaq. We're seeing a very strong correlation here, but the correlation decreased in 2021 and 2021. However, it came back up to almost like standing at 90 something percent. If we took a 90 days average correlation factor, and it's now standing at 90 something, 80 something, 90 something for Bitcoin to correlating to SPX and also Nasdaq. It's a really interesting thing for us to notice, right? Because we can deduce that the reason for this correlation is because there are more there's more institution participation. The crypto industry is evolving, developing, and maturing, and we are seeing more institutions coming in, stepping in, more demand from them, and that's why we can see that it's actually being traded like a risky asset, just like SPX and also Nasdaq. And what we can take away from this is that we can actually make advantage of this correlation. Right? We can take advantage of this data we observe here. If Bitcoin really tracks close to SPX and also Nasdaq, and then we are going to research to some traditional finance economic models to deduce the price and also demand and also support for demand and supply for these risky assets. So, for example, SPX and Nasdaq. That's why we showed you this chart. The relationship between government outlays, net exports, net ending, vs US GDP, and also 10-year Treasury yield and SPX, because we found out that these factors actually not only impacts SPX but also impacts the crypto price as well. We just took the correlation of Bitcoin to SPX and also Nasdaq. Probably in the future, we're also going to work on the correlation between Ethereum and other growing crypto assets. For example, maybe we can do a correlation analysis of some emerging new chains, for example, Solana, Avalanche, and other popular protocols, to see that if they are really tracked to other risky assets as well. So it's really interesting thing to notice here, and I'm going to take you to the correlation charts to look into details. And last week, we told you that we are working on the liquidity model from the federal balance to track the liquidity flowing in and out of the market. And that's why we have the correlation charts here. As I just mentioned, the SPX vs BTC correlation is really strong right now. Is approaching almost 90%, and that's really strong correlation we are seeing here. As for the inverse RRP versus Bitcoin correlation, we are also seeing a very strong correlation here. The RRP is actually the reverse repurchasement agreement offered by the federal government to absorb extra liquidity from the market. and if we see a very strong correlation here, and then why not we take advantage of this data to to bet on the data to bet on the model that we developed from the inverse RP and also the Bitcoin, and because if we inverse it RP and if you inverse the data of RP and then we found out that it's positively correlated to Bitcoin. So also in fundamental terms, like when RP decreases, Bitcoin goes up, right? Because it actually makes sense, right? Because RP is used to withdraw and extra liquidity in the market, and that's why we are seeing a supply stepping in Bitcoin when RP increases, right? Because money in the market would like to stick with the Fed, and they will not choose risky assets like SPX and also Bitcoin, and that's why it's a very useful instrument for us to to analyze to even forecast the potential supply and demand of Bitcoin in the near future. And we found that these instruments actually have a liquidity time lag to impact the market. For example, if we look at a 1 week delay and also the 2 weeks delay, we can actually see that we can see the difference, but I can tell from data that the inverse RRP versus Bitcoin correlation has a even stronger correlation in 2 weeks delay. So what we can know here is that the liquidity being extracted from market actually takes 2 weeks to leave the market, and we are going to see Bitcoin's price being impacted by an increase or decrease of the reverse repurchasement agreement after 2 weeks. And that's the strongest correlation we have seen comparing to the 1 week and also the original non-delayed chart. And yeah, so this model, we actually get the net liquidity, which we derive from, minusing the TGA account closing balance and also minusing the overall repurchase agreement in the Federal Reserve. And then we have the liquidity surplus, which we use to track market because we believe that the money that remains in the federal balance account is actually the one that's going to affect the market. For example, if RP increases, right? If RP increases and then the net liquidity decreases, it's actually inversely correlating to the liquidity that we are tracking. So basically, we're just tracking RP, TGA, and linking to the net liquidity data so that we can see a broadly, in general terms, in general sense, a positively correlating and also sometimes leading indicator to forecast the price of Bitcoin. Yeah. So maybe Dave, you can elaborate more on this model. Yeah. Yeah.
Cool. So I think Johnny has a very great opinion that we have like the blue color, the not liquidity, issue with the Fed balance sheet that we explained it before in the past weekly market chat. So if the audience or if you guys want to know more and more about or have the updates of the sort of like net liquidity in the indicator in the coming future weekly market chat, you can comment on our sort of like Huobi app and also our official resources that so that we will have to promise that we will update you guys if you like us too. So if we go to the global money supply year-over-year change in percentage, we tend to see that like last time when the RSI went to this sort of like 30, well, for the level of 30, so this range we tend to see a mega bump. So like to elaborate more, if we jump to like sort of like RSI based on global money supply year-over-year change, we tend to see a bump of the RSI back in 2015, also 2019, and right now are we going to have this sort of like bump? So I'm not sure, but I would like to tell or give a great tip by signaling on this chart. So also we tend to see when they're top, we also that we can signal from the RSI. So we have to we have to take a look on other levels like the year-over-year change or month-over-month change. So like if you have time, please I would like you to have a swing cap on this sort of like training wheel graph or training wheel chart. The thing is that this is like not difficult to do. It's free to do it, and everybody is I think to my sense that everybody is able to do it. With no pain or with little pain to other tools, financial tools like training wheel or stuff or data stuff. So for this chart I made it up free. So just for reference of you guys. And let's jump to the other topics on the sort of like tokenomics. So I think tokenomics is pretty like a pretty hard stuff. So when we have a bear market ended, let's say it's just an assumption that we tend to see in all like protocols or tokens that have an update. Like the Tron and the Tron with the stable coins update after the bear market, and also the now we're going to see a lot of like updates from the analysis or the tokenomic updates. So basically that the protocols are going to improve or have an update or have an upgrade on their economic model or the token economic model, and basically makes them more sustainable or more attractive or more demand than supply, so that more capital is going to be locked inside their token market capitalization. So for example, if we see a pub, the perpetual protocol, they have a rise from the very very weak point, like from the floor price to like 80% change or the token price. Basically they rise from the 0.553 cents basically to now like $1. They basically 100% pump. So for what we have a takeaway is that they announced the VE tokenomics, that is basically to vote the governance tokenomics. So let's jump to what's the problem of the tokenomics now for or or most of the maybe unsustainable or relatively less sustainable tokenomic model. So for the tokenomic model we see nowadays, we tend to see more incentives are going to run dry, and interest is going to get out, dry out. So why is that? Is because like a small handful of whales, just an assumption and a probability. If you take a look, a deep look, a very detailed analysis on how the whales are bleeding out, until it's dry. So probably this is sort of like normal for the DeFi protocols. I mean, for like less known or less well-known protocols. So this is also stated in the perpetual protocol governance proposal. So that and more apart from these wells, draining out the reserve, and we also have the incentives of users that are not aligned with the long-term health of these underlying protocols. Because like wells can vote it and use it, stake it for the governance, and immediately or with a small period of time, they get out and dump it on the market. So it also affects that the direction or the development of the really in that direction of the protocol is going to affect by the governance of these large institutions or whales. So when these whales are done with their tokens or the governance, they just dump it on the market and reduce a lot of price or capitals on. They produce a lot of like selling pressure on the whole DeFi protocol. So this is not going to be sustainably good to the whole market, I guess. So so what is VE tokenomics? So VE tokenomics is probably the commitment to lock up a long period of time to reduce oversupply. So by taking at this chart, so basically, Crypto Bunny is going to be the token holder. So they have a token time lock with the VE token that it is going to lock up for a winning power for a relative longer period of time. So why is that? Is it because like for a governance proposal, people are going to have more time or more sort of like reduction of supply or more demand for a longer period of time to commit to do the governance, so that the governance proposal is not just about, whether they are going to have more APY on this liquidity pool, or whether we're going to have more benefits on this sort of like governance proposal, but to have a longer time frame to drive a more sustainable long-term governance proposal. For example, any sort of tokens that can be bridged to this protocol, or any sort of development or any sort of ideas like to benefit and contribute to drive the adoption of this, protocol. So when this protocol is more sustainably held or more sustainably developed, we tend to see a higher tendency of the rise of the capital, so that we always call it a capital gain based on probability. So we also have the protocol fees that we direct from this chart, that and the VE token time lock is going to redirect the protocol fees to like for the token holders to earn more of the token and earn rewards. So this is also a win-win situation, that the token holder has a longer time frame of the governance proposal. They support the more incentives to support the protocol on a long time frame, and also have the rewards token rewarding them alongside with the long period with the governance. So for the governance proposal, for protocol side, it's also very great that they have sustainable opinion or sustainable development or adoption on the protocol based on this longer period, and also the incentives. So let's jump to like what's the takeaway for the audience is what I really want to tell you guys is that for the when there's a bull phase one, or when there is another phase of the bull cycle, we tend to see more and more coming updates, like Ethereum proof of work merging to proof of stake as a catalyst. We're going to see, like more like tokenomic updates, that if we see that there is more demand side on a tokenomic update or upgrade, we tend to see a rise of the, token of that protocol or that specific protocol. So previously we have a lot of like tokenomic model that may not be rather or comparatively sustainable, like for example, infinite supply or infinite inflation rate, or unsustainably high inflation rate, like 160% APY, just to benefit from to the farmers, or some sort of like whales, or some sort of like early investors, like very aggressive vesting schedule, like for in day and two we tend to see have a 30% vested in token just dump on the market. This sort of stuff are not sustainable. So for the upcoming bull market, we tend to see more and more sort of like cases of the update or the upgrade on the tokenomics. If we see that the tokenomic upgrade is good, it's going to drive a demand or not. So as a trader or investor, we're going to analyze if we're going to see more demand, more adoption, a less tendency of supply or aggressive inflation schedule. So we are going to see a more, a bigger driver, or the, drive up, the token price of that specific protocol with token number updates. That's basically catalyst. So we can also check on this catalyst, by typing in tokenomics or tokenomic upgrade on Medium, on Twitter, on other crypto, native like articles, like the blog research and stuff. So that's my takeaway. So do you have any sort of like opinions on these sort of like topics and tokenomics and upcoming updates or stuff, Johnny?
Yeah, I think one thing that you mentioned is very helpful is that we can actually learn from, the upgrades of these projects. We can learn that if these projects, for example, like Chaining, Uniswap, and also Aave, if they have upgrades, that probably mean they have a lot of demand, which their community members want to improve something, and then they have the upgrade. And that's what we have, what we can learn from them is that we can see actually there are utilities, and also there is demand from the community. And these are actually some good projects with good fundamentals and also with good utilities. That's why updates and also developments of these projects are actually some good indicators that they are improving and also they're developing. And that's what us investors need to know. And yeah, I think you already have some very good points up there. And so that's what I think about. So moving on, we have the candy drop, and a lot of you guys, I think have been anticipating for a long time. So make sure you have 100 USD trading spot trading volume of any assets in the last 3 days, so that you can be qualified to enter the candy drop event. So our winners can win up to 100 USDT per entry and up to 1,500 USDT per week. And we also have the double kill points in case you didn't win the candy drop event. And one lucky star will get 1,000 USDT, and that's what the main price of this candy drop event. So make sure you have the enough trading volume. If you don't have, make sure you go on the spot and pick some few coins to stack up, and then make sure you have 100 USD spot trading volume, and then get registered for the candy drop event. And yeah, we will be delivering more nutritious and also useful content next week in our next episode. We'll actually drill into more detail about our model that we are actually working on tracking. Remember, we are tracking the liquidity inflow and also outflow of the Federal Reserve balance, and that's what we are working on right now. And I think it will be very helpful for you guys to forecast the market. And make sure you stay tuned. And yeah, thank you for watching, and thank you guys. See ya. Peace.